For more on what we're seeing in the bond market and what it all means for the economy and the Fed, we're joined by Gilbert Garcia, Garcia Hamilton and Associates owner and CNBC contributor, along with Lindsey Piegza, who's Stifel's chief economist. Welcome to both of you. Gilbert, I'll start with you. Give us some kind of real world wisdom here. There's some people talking about is 50 basis points for the Fed on the table as a cut in the wake of this. You got any sense about what's going down here?
Sure. First and foremost, thank you for having me. I think the Fed would be making a big mistake to be raising rates at all anymore. You got to go back in time. When we were back at this point of inflation, back in the fourth quarter of 21, we were still doing quantitative easing. We were still doing all those things when inflation was just where it is now. And here it is, it's back. And here we are tightening money. We got quantitative tightening, money supply growing, negative growth. I think they should stop raising rates now and let the economy settle. It was inevitable that they were going to break something, and I think this could be just the tip of the iceberg.
Lindsey, react to what Gilbert just said provocatively there.
Well, I think I'm going to take the other side of the coin. I don't think today's events are going to impact the Fed's policy decision in just about 2 weeks' time now, as long as the Fed views this as an isolated event and not an indication of a broader trend of contagion or crisis in the financial market. And assuming the former, I do think, coupled with this morning's employment report, the still hot level of inflation, the Fed is going to continue to raise rates. And in fact, looking out to next week's CPI and PPI report, if we do see a hotter than expected number, the Fed is likely to keep the door open for an even larger 50 basis point increase.
Well, let me press a little bit, because Gilbert's point is an important one, and that is that there are often unintended consequences of policies, whether they're monetary policies or fiscal policies or whatever. And here may be one of those unintended consequences, i.e. that banks or other investors who bought Treasury securities or other securities at low interest rates are now finding that the value of those assets on their balance sheets have been cut very, very dramatically. And that puts them in some cases, in this case of SVB Bank, in a truly precarious position. So speak to me about that and how sensitive the Fed may be to the idea that, oops, here's an unintended consequence that could be rather more, I don't mean to say systemic, that may overstate it, but more widespread than just one isolated incident.
Well, I think maybe I would push back on the notion of unintended consequence. The Fed is well aware of what they're doing and the consequences that are likely for not just financial markets, but businesses and consumers alike. And so the Fed has been very clear that as they continue to raise rates, again, they have been communicating this to banks, to financial institutions, to the market. And so they're trying to get us well positioned to anticipate this further backup in rates. But they've been very clear that not only is a period of pain likely, but it's necessary to get price stability back in place. You don't
seriously think they wanted a bank as big as Silicon Valley with as many business customers as it has? You don't seriously think they wanted it to fail?
No, certainly not. And that's not their intention, to cause further bank failures at this point either. But we do have to be cognizant of the limitations of Fed policy. The Fed, again, has been communicating to these institutions that rates are going higher. So it's not on the Fed to handhold risk management of individual financial institutions. It's their proxy to reinstate price stability and ensure maximum employment.